Well, hello everyone. We are here with Ryan Skaggs with Neighborhood Loans, located here at
101 Green Bay. So we're the last address here in Wilmette. So right
right
across
next
the
to Whole
street from
Foods,
Edison. Yep,
right? Right,
that's which
right.
is
Yeah.
dangerous.
So we're pleased to be able to have a chat with you to get an idea in terms of your thoughts as far as what is going on with interest rates based upon the current market and so forth.
Yeah, so we're sitting here, March now, mid-March, and it's been pretty frothy, pretty volatile so far this year. One of the lines that I use and talk to clients about is headline risk, is that we are at more of a risk for a headline than we probably ever have been before. There is more just some sort of news that drops in we weren't expecting, a new tariff, a new this, a new that, whatever it may be, that has swayed the market one way or the other. Typically, it's a knee jerk reaction. We're getting back to normal, but it has been back to pretty volatile. So, hoping that that will decrease as we get into summertime. But thus far, we've kind of been in that mid six, high six range. We haven't seen anything, where it's really peaked up above that. Obviously, we saw times in the past few years where we were well above 7, almost 8% on the average 30-year fixed, which was pretty hard to swallow after
Right.
twos and threes there for a while. So, with that said, I tell people all the time is I call those generationally low rates. We're just not going to probably see those in our generation ever again,
Yeah,
right?
no more
So
2.75
no,
or
No.
3% or whatever. So
yep,
kind of manage expectations at this point. So one of the things, the market does not like uncertainty, right? The
mm-hmm.
headlines that you're talking about. And what I'm hearing or what we're hearing is that money, like investors are starting to go more towards the bond market, shall we
Mm-hmm.
say? Is there some truth to that?
Yeah,
And
we've
that
absolutely
impacts
seen
rates
that
also?
this spring, especially here at the later half of the first quarter, where they're just shying away. I saw an article about Buffett. I don't know how many billions he has in cash right now, but basically, there's a lot of big investors, a lot of big institutions that are going more into cash, more into bonds, more into safe, secure, which I sure hope means obviously 30-year fixed, easy, rate of return type stuff. So we have started to see that where we've had a nice little reprieve, but we need a bit more, I think, to really loosen the market up. As you guys know, it is very, kind of low inventory, seller driven, and we need to drive some more inventory, especially for more affordable homes here in Wilmette.
Yes.
It's very tough for, say a family moving up here from the city. Amazing schools, amazing parks, amazing everything, but it's just so tough to be able to afford, coming up from, say, a 2-bedroom condo in the city or something, right? So we just need more inventory to open up. But to that 2 and 3% conversation, if you're sitting on that, you probably don't want to do anything yet.
That's
So
right. And that's what we're running
that's
into.
tough. So
We see that quite often where people are just staying in their house, they're
mhm.
not moving because they've got these low rates.
Yep. I think at some point though, you can almost just wipe away 20 and 21 from, it was COVID years, and life was just considerably different for everyone in every way, right? So now we're getting into families that have been in homes for a few years without that extra bedroom, or without the bigger backyard, or without that said thing. So we're starting to see that I'm starting to see clients willing to give up a 3.5% rate to come into this market, but they can't find anything. So there's still a challenge on that end, but there's more and more willingness to entertain this market than maybe in the last couple of years, because that was tough. I mean, for mortgage originators, I mean, we lost tens of thousands of mortgage originators just from a job profile. I know there's a lot of real estate agents that aren't in the industry anymore as well. So that was a tough couple years for mortgage originations, but they're showing 10 or 20% gain on last year and again in 26. So hopefully it'll slowly start to kind of thaw out as we're moving forward. So.
Mm-hmm. Mm-hmm.
So we hear then that probably again those 3%, rates that is not going to happen.
Mm-hmm.
Do you foresee, and what are you hearing that potentially could they get to say 5%? And the only reason why is isn't there like a rule as far as out in the bond market is as bond prices go up, right?
Mm-hmm.
And it's kind of that supply and demand, then rates actually kind of go down.
Yeah, I mean,
so
kind of
ultimately,
basics from econ is, the the price, goes up of, said bond, and the yield is the opposite, right?
Right,
So that
right.
yield will go down. So, the 10-year treasury, a lot of people like to correlate to the 30-year fix. So if you go watch CNBC, you see 10-year note, that's usually a good indication of what's going on in the 30-year fix market, mortgage market. So it's not a perfect day to day, but if you look over a month to month or year to year, pretty nicely correlated in terms of those lines. They're very close together, right? So I do think there's going to be more and more of that. I think there's going to be some potential fiscal policy that's going to help us, get a little bit lower rates. I personally don't think we're going to see fives for a couple of years, and to even go out that far based on so many uncertainties right now, it would be tough to do. But I could absolutely see a, average six flat or low sixes pretty easily in this market. But that also means, good side of that is if you've got a multi-million-dollar home and you've got to want to look at a 5-year ARM, you're at 5%. You're at 4.75 maybe. You're well below what a average 30-year fix might be. But for the average consumer that might have 10% down, 20% down, getting a 30-year fix, have a good or above average credit score, that 6 to 6.25 is probably about as good as we're going to do here for the next 12 months. Is at least where my kind of, if I'm putting the odds out there, that's where I'd be at. But those in that jumbo market space do have an opportunity to either take cash out or maybe make a purchase, or maybe they didn't want to move yet until some of the unsettling stuff kind of slows down a bit. And then I think there could be some opportunities in that market for sure, because that's been a lot of cash and a lot of just not moving and not doing anything.
So I think then what I'm hearing you say is that for those people that have been sitting on the sidelines, kind of waiting for rates to come down, that potentially it's probably going to be a while, and nobody, like you can say with certainty.
I don't believe there's going to be a time where you're going to see, well, especially if you're a buyer, specifically a buyer, you're going to be buying in this market. I would be, just hugely against the waiting game of, you want to pay 10% more in a year or two to get a quarter or 0.5% lower in rate. And in my mind, you're going to be in a more competitive environment if rates move down than maybe where you're at before. Now, if you're a seller and maybe you don't need to purchase something, or you can be very flexible, then like this year, looking at just such an amazing seller's market, right? Like, why wouldn't you take advantage of that?
It is
right?
a good time to be a seller, right?
So
there's no doubt about that.
On the buy side though, for sure, if you're sitting there waiting for a 0.5% lower in rate for affordability, but you're not taking into consideration, the low inventory and the appreciation we're likely going to see in the real estate market, then I think it's going to be a slap across the face in a couple more years, right? So
That's right.
the old phrase that when's the best time to plant a tree was 20 years ago or today, right? So it's one of those, like, it's not gonna, there's nothing out there that tells us it's going to get a lot better, from an interest rate with price perspective, right? If you only said interest rate, then you're just potentially going to afford less of a home, in a few years than you would now.
So going to the Fed and potential rate cuts, what are you, because they just recently, right, Met didn't do anything. What are you hearing potentially?
The easiest, to that answer to that question would be June. And I know that's not maybe an answer, but over 80%, prior to going into this most recent Fed meeting, over 80% suggested that it was going to be a June rate cut. Okay. So more than likely, now it's probably more like 90% or maybe above.
Got it. But I think then really the moral to the story is don't wait.
Yeah.
If you are a buyer, right? That because rates more than likely you just can't predict. And even a year ago when we were talking about numerous rate cuts, and then soon there within the first quarter, I think things changed. You can't rely on that. So if that's part of your long-term strategy as far as you really want to move, then you in terms of buying,
it goes back to that cliche phrase of you marry the house and take the rate. I mean, it's so true though. It's like, if you can acquire the home in an appreciating real estate market and then give yourself the opportunity to refinance at a future point, then you get the rate.
Right.
If you don't
Right.
have a home, then you don't even need a rate. I mean,
Right.
what's it have to do with it, right? So
I love that. The
um,
marry the house
yeah.
and date the rate.
It makes
Yeah.
perfect sense, though.
Yeah,
Yeah.
you're
Sort
going to
of
be in the
corny,
home
but
for, potentially a decade, typically. And you might have this mortgage if you're buying in 2025 for 24 months max,
Got it.
right? I mean, I just can't see a reality that you're going to have this same mortgage for 5 years from now. There's going to be an opportunity again with volatility and
sure.
different economic policies, and we'll see a dip, at some point. Now, will we trend all the way for a long term? Maybe not. But, could we see that dip where you'd say, oh, I want to take this opportunity to go from a 30-year fix to a 15-year or to a 7-year arm or to something else to save that interest rate difference? Yeah, absolutely.
Yes.
I'm going to put some money on that being an opportunity in the future.
Well, one of the things I know as far as trends that we are seeing, certainly with some recent listings that we put on the market here in Wilmette, is we're seeing a lot of cash offers or cash with the option as far as a mortgage.
Yep.
And I know that there are creative ways of structuring your offer. Again, the cleaner, the better. And so for somebody that does have, let's say, the need to do financing, is there a strategy that you can kind of coach them on how to make their offer all the more, attractive to a seller that might also have these cash offers on the table
Yeah,
as
great
well?
question. I've been talking a lot with clients about what the cash with option mortgage means.
Yeah.
All right, so 3 different areas, or kind of same paragraph, but 3 different areas of I'm going to get a mortgage, I'm going to pay cash, and then this hybrid right in the middle. And I've talked about what that means. What are you giving up? I use an example just to kind of shorten it down is like, do you feel stable in your position? If you feel stable in your mortgage role, or in your occupational role, then you probably don't have a lot of concern qualifying for a mortgage. This would be an opportunity to consult with your attorney and say, should we go cash with option mortgage? Now, there's also consequences to each one of that. That's why I always say, hey, reach out to your real estate attorney. But if you really want to get, at the top of that kind of list of offers, then this is definitely an option to look at. And we talk about how we could show proof of funds and different things. Could you borrow from this? Could you do that? Those sorts of options. With, I would say 95% of the time I'm speaking with people, they have every intention of getting a mortgage, right? And 100% of those in the last decade has gotten one if they wanted
As
one.
far as the
Right.
cash,
Yeah.
they had a cash
Yeah.
offer, but they
Yeah.
ultimately got a
Yeah.
mortgage.
Cash
whether
with
it
option
was
mortgage.
prior to
Yeah,
or
it just
after
it gives the
closing.
opportunity for the
Yeah.
appraiser to come in for additional visits for whatever else, which normally a seller might not have to do that. It's
Right.
a 2-week close. Like, okay, we'll see you in 2 weeks at the closing table, right? So cash with option mortgage and allows them, obviously you got to give enough time, but allows me, say, a 30-day close for an appraiser to come in. You're not going to be able to walk away if it doesn't appraise, or something like that. But there's, in this market, again, in an appreciating real estate market, those opportunities for missteps or whatnot are pretty low. Now, I use this example and I, tell this and hopefully get a laugh out of some people. I said, if you feel stable in your role, just keep in mind everyone at Enron was there on a Thursday and they were in boxes on a Friday. I'm sure they felt really stable. So you have to keep in mind, but your consequence is what you're putting up in earnest money. So if that happened, are you willing to give $40,000 to the seller and walk away and say goodbye?
Well, that's a great
that's up to
question.
you.
And
That's a question I'm
scary
going to let
question,
you
too.
answer, right? But
But
if you're in a stable employment role, though, then there's ample opportunity to be extremely, kind of aggressive with your offer or be a clean offer and compete with cash. Sometimes people think they're just not going to have that opportunity, but they really haven't consulted with someone or chatted through all the different opportunities, kind of pros and cons with it.
so one other that I was going to ask you is about the power bid.
Mhm.
And again, that would be with somebody that actually does need to do the financing. They're not in a position to, or just not comfortable, right, with the cash with the option of a mortgage. So is that something that you promote?
So what we've really been focusing on is, getting clients fully underwritten. So that way they could go in and say, we want to close in 2 weeks. If you go to a seller and say, hey, we have to finance, but we can close in 2 weeks, we've already been fully underwritten. then that's a great opportunity where we don't have to necessarily look at their current property or what would they sell for and do a bridge loan to get money out or anything like that. We can just say, hey, you're non-contingent on the purchase. You've got X amount of dollars, but you've already been through underwriting. So now all we need is appraisal, title, insurance, and off you go. And we've been doing that a lot in the spring to be competitive. And it's working, to be honest. So especially with other financed offers. And if you're competing against cash, if you can think, I've already been through underwriting, I've already provided all my documentation, my lender has already reviewed it, a physical person has actually reviewed this, give you kind of quote unquote stamp of approval up to X amount, and you're underneath that, then at that point, and you want to close in 2 weeks to a seller, it's like, they're pretty far along. You know, there's a lot of certainty here, right? There's a lot of certainty and far, far less unknown. Then at that point, you do something around the appraisal to maybe make a seller feel comfortable when you're competing with every offer.
And that's where you promise, you in your offer, you say that you're willing to, what is it? It's for the appraisal gap
waiver. If it doesn't appraise for X amount, then I can't come to you, seller, and walk away. Right? Again,
that you're willing to pick up whatever that differential is in terms of the appraisal.
I've had a lot of people that think that that's happening all the time. In reality, it's like the exact opposite. When prices are going up, yes, it's always tough to continue to stay on that market, but there is 5 comparables every time with multiple offers, somebody paying up, a per square foot price or whatever it may be. It's the super unique properties or more rural properties that it's really tough to, for appraisers these days to be able to appraise that out. But for, Wilmette and, Metro north of Chicago, like there's plenty, there's ample, and we're not having any appraisal issues on that end. So to that effect, now you're just getting clean title, insurance, earnest money in, send it back in the underwriter, and we're done in 2 weeks. And if you want to move that fast, it's capable to do.
Well, I think that's good to know.
Yeah.
That people have that option and that they can go to you.
Absolutely.
Right?
Yep. I mean, we've been talking with clients about this for probably over 18 months or so, to be honest. But now more than ever have we been kind of outlining having a physical underwriter, someone that I deal with every day that's, on my team, to be able to say, okay, hey, I need this and this before we get this, but getting that stuff out of the way. Because if you're just putting a letter out there to a seller, a pre-approval letter, and it's from a 1-800 number, or you've already been through underwriting, I mean, it's someone that's never bought a house before, you've bought and sold 10 times, that should be pretty easy which one you're going to pick.
Yes.
Right. So I think there's a lot more than the words that are on that, that letter, a lot more to the logo on the top or something else. A lot of people think it's more commodity, and it's like, man, I can actually help you get the home. Yes. Right. Like not just issue a letter and say, here you go, best of luck, go on your way, Johnny. Right. There's a lot more opportunity to help clients get into homes. Obviously still competitive. So that's tough, but there's ways to do it. Right. So,
and I think the other thing too, to share is that in our community, and certainly as an agent and a listing agent with the property, and the buyer on the other side is working with someone such as yourself, you feel so much more comfortable because we know what you do. So you really are.
And I'm calling, on the other side too, to say, hey, we've already done this. We reviewed that,
well,
to give a sense of like,
so good on staying on top.
Yeah. Thank you.
Keeping everybody apprised, which I think is why we are here talking to you right now. So, well, wonderful. I mean, this has been so incredibly helpful.
Yeah, absolutely.
So again, if you want to, we'd just like you to share again how people can find you.
Yeah, absolutely. Yeah. Well, first of all, we're here at 101 Green Bay and Wilmette, Neighborhood Loans, and then feel free to give me a call, 773-917-8553.
And then, you can also kind of go to Whole Foods right after.
Yeah.
Right.
You can get your grocery shopping, get pre-approved, all in one fell swoop. So.
All together.
All right. Well, Ryan, thank you.
Thanks, Ryan.
Oh, my
really
pleasure for sure.
Appreciate it.
Yeah. Thank you.